We're actually adding a little bit more on to the North America Q&A. So showing our agility here. So if I can just get Claudia and Sally Lavanya back. And I think we probably have, what do you think, about 15 minutes that we can do if we want to take a few more questions, because we kind of had to cut it off there a bit.
Oh, just hold it.
Oh, wait.
Yes. Technical issues.
Oh, very good. Vivian? Where is she?
Thank you. And thank you for the extra time on the U.S., Deborah and team. So as I kind of think about the commentary around the stabilization in TBA, certainly that must contemplate the fact that the beer trends in the U.S. are deteriorating. So that's helpful from a TBA perspective, not necessarily from a core spirits perspective. So as I think about the commentary from Friday around a gradual sequential improvement in the U.S. or North America more broadly into the first half of fiscal 24, I'm just curious how you guys are thinking about November and December, because some of the scanner data outside of spirit showed a material degradation in trend in October specifically, given the resumption, we think, of student loan repayments. So how much of a win do you really need in November and December to show that improvement? Thank you.
Yeah, so I think, I'll start by just, look, it is a critical time of the year, and we are actually, Vivian, quite encouraged on sentiment for the holidays. So that is exactly what we are planning for. So we, so with that, I would say we also, certainly are looking at trends, but I think October, you're feeling good about.
Yeah. I think
it's already in the bag.
and Vivian, I would say, it's the consumer sentiment also by occasion. So one of the things, we look at very carefully is the sentiment as it relates to the on-premise, for example. We've been winning consistent share in that channel. And the sentiment towards the on-premise is positive. Our monitor would suggest 15% more intent to go out. Now, there's no perfect data, but we were on the road. We met with a lot of national account on-premise customers, so we can look at bookings. For November and December. And so when you look at private holiday events, it seems to be encouraging, what accounts are telling us in terms of their bookings. And then obviously it's our job to make sure that we have menu placements, we have programs and staff trainings in place. So that's one element. And then I think, Deborah, to your point, we are now in the season of the most important entertaining holidays, between obviously which Diwali here in New York was the first time a holiday, and it's becoming a big consumption holiday as well. We have Thanksgiving, we have Hanukkah, we have Christmas, we have New Year's. And so we're making sure that we look brilliant at the point of purchase. Look, from a consumer standpoint, I hear what you're saying. Student loans and things have been on people's minds. But that also means I think they're really looking forward to spending time with friends and family, in the coming 2 months. And so it's all about showing up brilliantly at that point of purchase, being available as a gift. That's another lever, we're really leaning into. We are an affordable luxury. We make a great gift. We're activating across multiple sizes because that gives us access to multiple purchase price points.
I will add though, we would not have reiterated sort of the sequential improvement unless, we felt very good about it. So.
Yeah. Chris. Microphone.
A couple of questions on the US again for me. Chris Pitcher from Redburn Atlantic, sorry. You mentioned your A&P ratio had gone from 15 to 20, but market share hasn't stabilised. So is 20 enough? And then secondly, if we look at the second half performance of last year, actually Johnnie Walker was quite a big drag, and you've not really talked about Scotch in the US. You've talked about all the other ones, but it was a bright point for a bit, and it's gone negative. How's Johnny Walker doing?
Yeah, I'll let you start with Johnny Walker, and then I'll take the first.
Look, a lot of what happened with Johnny Walker was what it was lapping. So it was more of an NSV drag than a business problem itself. And what it was lapping was the refilling of, shortages in fiscal 22. So, with all of the port congestion and how hard it was to get supply in, the very long lead times, fiscal 22 was a pretty poor year on a number of our brands. And so, it was the lap of that, it was 21 that was a bad year, 22 was the refill, 23 was the lap of the refill. So that was the issue on Johnny Walker.
But if you want to talk about
from a share perspective, we're gaining share, significant share of Scotch. Scotch grows a little bit smaller than whiskey, but our trends in particular on Johnny Walker Black, which has been the heartbeat of all of our efforts, is continuing to see really good momentum, and we expect that to continue over the holiday season. So from a share perspective, I feel great.
And I would say on the 20% reinvestment rate, I mean, look, we don't really target a specific rate. I mean, the region is margin accretive for us, and so we do tend to, if we need to spend there, we are inclined to spend, but we do look at every dollar that we spend, every event. We've got Catalyst, which I think we've talked a lot to you guys in the past about some of the tools that we have to measure ROI in our marketing dollars, and actually when you tour the occasions area this afternoon, it's got our marketers from around the world, and they will absolutely verify for you that they have to look at every event before they get the next dollar. And so, we regularly look at that. But if we need more money in North America, we try to get it to them. I would say in the past, this has been a place where we have steadily sort of, improved investment as our portfolio has expanded and as we're seeing, the opportunities and occasions.
Cedric?
Jeremy Fialco, HSBC. So a couple of questions on the two areas you talk about where there was some share loss. So first of all, if you talk about Crown Royal and some of the shelf space losses, what visibility do you have in terms of getting that shelf space back, in terms of some of the resets when those are happening, and kind of like what the retailers have committed to you in terms of actually you getting those facings back, which you lost? Yeah. And then secondly, on the Cristalino Casamigos, again, what sort of like distributor commitments have you got from those? And what would the sort of incrementality to the brand in terms of reversing some of the trends that you're seeing at the moment? So just some more detail on both of those points would be very helpful. Thanks.
Claudia, you want to take that?
So I'll start with the latter one on Cristalino. Without getting into specific distributor numbers, what it is providing us is giving us access to different serves within the Casamigos family. So we were actually out and about, and one of the features that the team is really working towards is a martini or also a Negroni serve, which actually the liquid is fantastic, makes a fantastic cocktail. And we just got some of the commitments from national accounts on premise over the holidays. I haven't even shared that with you, Deborah.
Okay.
Ruth's Chris is giving us access to additional features and additional menu placements. So we're really excited about that. And we've seen the success of Cristalino with Don Julio. And to this day still for Casamigos, it's a fraction. And of our, you can tell the story of just the success of Don Julio 70. So it's the very beginning. It's been in the marketplace for a couple of months, but we're really encouraged by the success that we've seen so far. And as I said earlier, we're now also adding smaller sizes. It is a $60, recommended selling price. $375 is a $30 price point, so we're excited about what that can deliver in terms of incremental occasions for the holidays.
And then the other question was visibility on how you have visibility into what's going on.
Yeah, and I think this is where tools like Trax and Edge are really important because the sales consultants in our distributors are using those tools to basically take photographs of shelf sets, and we have now repositories of those shelf sets over time, so we know where we have suffered the most in terms of visibility, and that's where the sales consultants go back and have conversations, especially also with the new news around the packaging, which Sally, you mentioned, the new news about our media campaign. And we're going to regain them back. To give you an exact timeline is, to be honest, really hard because it is individual accounts. To your point, it's national accounts as they reset. But that's the journey we're on. And as I said, on Deluxe and Apple in particular, we've really stabilized our trends.
And we can prioritize people. You saw the map of Texas that we put up. We prioritize sort of where it matters the most to go back and do what we need to do. So it's actually very, very cool data.
Olivier.
Olivier Nicolai, Goldman Sachs. Just a couple of questions. First of all, on the US, you mentioned, I think TBA share was 7.5% earlier today. RTD is obviously growing very fast. Now, what's Diageo ambition in the category? And do you think you could get your fair share in that segment? Could this be dilutive in the meantime until you get there? That's kind of the long first question. Sorry for that.
Yeah.
Secondly, on the midterm guidance, just wanted to understand, under which scenario could you really get to 7% organic sales growth? And then you showed us this morning, I think it was a top 3 contributor by category. You've mentioned some disposals that you've done previously as well. Do you think you still have more brands to dispose which could effectively boost the growth rate of the company? Thank you.
Okay, so if you can hold, we'll come back to you first on the medium-term guidance session as we go through that. And then, TBA, and so as you think about RTDs within TBA, so how we measure that and look at that that is taking it sort of, I'll call it anything that is not beer that's in a can, right? So if you think about the seltzers, the FMBs, all of that, if you roll all of that together, actually that universe has stayed because you really are mostly seeing consumers come up that curve. And so within that TBA world, I actually think, for one, we're already a player, right? Because we do have a good size FMB business. We've got a little, pocket, I would say, within seltzer and that kind of agave, Lone River. I'm saying the wrong word for it.
Ranch water.
Ranch water. Thank you. And so that piece, we have a small piece there, and then we have a small piece of the spirit. So actually, when you roll that up, we should be able to get our fair share. And I think that is one of the key things as we're looking at our innovation plans and what we're doing. But there's no reason to not be able to get our key, our share of that, because that's in a broader TBA universe. And we absolutely look at that. And I think we can talk about some of the FMB stuff because we do have some things that we're launching on the FMB side. Do you want to talk about that, Sally?
Yeah, and it's interesting to think that it was Diageo that kind of launched this with Smirnoff Ice all those years ago, and it's still doing incredibly well. So the team is launching a Smirnoff Smashed, which is actually delicious. They're also launching a Captain Morgan Sliced. So both, I'm looking at Rodney. Did I get that right? Okay. So those are coming out in the second half. So that'll absolutely continue to grow our share.
In the FMB space. So much wider, of course, distribution and availability on, on that, within RTDs.
Yeah. I can take the question on disposals.
Yes, on disposals.
Yeah. We're always looking, Olivier. I mean, you've heard us talk about this over the last several years, but we're very active portfolio managers. And we are equally active on the acquisition side, but also on the disposal side. Most recently, we finally completed the disposal of Windsor, the whiskey business in Korea. I mean, John can't stop beaming about that. So yeah, but we're always looking at our portfolio to see if there are parts of the portfolio that just do not fit within our construct right now. So yeah.
Any other questions? Oh, there you go. Brett.
Thanks. Would love to ask a question on RTDs from a different perspective. It would seem to me that they're easier to convert those consumers or occasions into your bottled portfolio than it may have been historically. So how do you go about doing that? And is that a true assumption?
I mean, look, one of the things, and I think, sort of even prior to me is, if Ivan were standing up here, we have always thought that this ultimately would be a very good thing for spirits, because to your point, especially in a country like the U.S., you forget just sort of how big, sort of, even though it's, it isn't growing, but in that mainstream beer place where there's a lot of occasions there. And so that really, when you think about how, when you turn sort of 21 and you're coming in to the category, mainstream beer and sort of that used to be where people came in. Now we're seeing numbers where it's much more of people coming in these kind of things other than beer, and it certainly does, help that come into spirits. And so that's why, ultimately, over the long run, we think this is going to be very good, and we think about it, and that's why we think about which brands, and we really do try to pinpoint. I keep coming back to this, but occasions are really important for us. On those occasions of which we know we can convert people into our brands, and we see it. Sally mentioned this morning on the ready to serve, our Bulleit Old Fashioned in Manhattan, how that's actually reflecting back on within a certain amount of time, people are actually coming into the Bulleit franchise that weren't there before and buying the bottle of Bulleit. So that is a good assumption, and we actually do see evidence of that, and think that's a very good trend for the long run.
And Deborah, maybe if I can, another example is actually our kettle espresso martini, because you asked about how do we bring people in. If you look at how we activate espresso martini, we actually activate espresso martini, yes, through our ready to serve for those moments where you're really busy and you have a big party and you don't want to relegate, somebody at the party to make cocktails all night. Buy that espresso, martini made with Ketel One. We equally co-display, for example, Ketel One vodka and Mr. Black in stores. And so for the consumer, who has a party, who wants to, create that moment and create a great cocktail bar, it's available for you as well. But it's using the same platform of the most popular cocktails and bringing consumers and telling them about, the fantastic quality that is Ketel One. And if you look at the trends of, Ketel One in the U.S. Right now, we're gaining not only share of vodka, we're gaining share of spirits overall with Ketel One, which is really encouraging. So it's really a surround sound to your point, and it is bringing and recruiting consumers into Ketel One vodka, which is the ultimate goal.
All right, I think we're
Very
at time.
good.
Thank you.
So that was our bonus Q&A.
Okay.
Thank you. So in the final section of our presentation, we will talk in more detail about the fundamentals that allow us to pair quality growth with robust financial performance. So before I hand it over to Lavanya, I want to talk about the intent behind our updated medium-term guidance. As shared throughout the first part of my presentation, all of us at Diageo have huge confidence in the attractiveness of our industry and category. We also believe in the solid business we have built over the years, the consistent investment we have made in it, and we have the talent, tools, and capabilities to drive sustainable growth. Moving forward, we expect to deliver organic net sales growth between 5% and 7%. This is ahead of what we were growing pre-COVID, and is consistent with our medium-term guidance provided 2 years ago. Lavanya will take you through the detailed building blocks, But our confidence in this guidance is fundamentally underpinned by three things. First, our participation in the attractive segment of international spirits, which is growing ahead of TBA sourcing from beer and wine occasions. Second, our advantaged portfolio and footprint, which enables us to grow ahead of spirits. And third, the investments that we will continue to make to grow share. So given our share and growth ambition, we will continue to invest behind our brands. And I'm proud that we have stayed disciplined with our investments over the past few years, regardless of the operating environment. It's paid off, as we have shown you, and Lavanya will also discuss in more detail. We see no reason to deviate from this successful model. We firmly believe that maintaining the capability to remain invested in the current economic uncertainty and global market volatility is essential. As we expand our portfolio footprint, reach more consumers, and gain more occasions, this ensures that we have resilient brands in the near, medium, and long term. It keeps us competitive in the market to ensure we can continue to outperform this attractive industry. To be clear, the change in our operating profit guidance is not a change in ambition or intent, but is meant to reflect a realistic and transparent view of the projected macro environment that we expect to be operating in. As inflation moderates and productivity from our supply agility program flows through, we expect operating profit to grow ahead of organic net sales growth. Lavanya will cover this in further detail. Another important element of our medium-term guidance is how we continue to think strategically about our ambitious ESG agenda, Spirit of Progress. We continually review our approach to ESG to ensure we focus on the issues that are most material to our business and prioritize actions that strengthen our performance, whether delivering efficiencies, strengthening our brands, or driving employee engagement. The world of ESG is changing fast, and the needs of our stakeholders are evolving. We're nearing the halfway point of our Spirit of Progress plan, so I've kicked off a review of what we've learned so far and how we continue to ensure our near-term priorities fully deliver for performance and productivity. This review will consider our commitments in three areas. Those where we will maintain our current programs and commitments, where we will accelerate actions given changing stakeholder needs, and areas where we will need to focus our efforts to ensure we are prioritizing and pulling forward the actions that deliver growth and efficiency gains. In particular, as we work to decarbonize our value chain, we and our industry bodies continue to advocate to governments to put in place the essential infrastructure and incentives required in both direct operations and supply chains. No company or sector can deliver full decarbonization alone, and we and governments will need to forge new partnerships and a supportive policy environment to deliver net zero. So as part of this, we will also explore options to rationalize how we measure progress and streamline our external reporting, simplifying disclosures where possible to benefit investors and other stakeholders. We will update you on the results of this review in due course. So with that, I am happy to invite our CFO, Lavanya, to present the financial foundations of our performance, our growth algorithm.
Thank you, Deborah. In the next few minutes, I will cover how our growth algorithm supports Diageo's virtuous cycle of sustainable growth. We drive sustainable growth and profitability through volume, price, and mix improvements. Our culture of everyday efficiency helps us deliver productivity, and we return that back into the business through bold reinvestment. This enables us to further accelerate our top-line growth and share gains, and positions us well to achieve our TBA share ambition while driving shareholder value. I will now walk you through a breakdown of our performance in the past 6 years and why this gives us confidence in our medium-term guidance. So let me start with top-line growth. Since fiscal 17, we have outperformed our peer group with strong top-line growth. Prior to fiscal 20, top-line growth was consistently in the mid-single digits. While fiscal 20 and the first half of fiscal 21 were significantly impacted by the pandemic, our business proved resilient. We recovered strongly in fiscal 21 and 22 when we delivered 2 years of double-digit net sales growth, well ahead of pre-COVID levels. In fiscal 23, we grew top line at 6.5%, at the top end of our medium-term guidance of 5 to 7%, as growth normalized in line with our expectations. Top-line growth from fiscal 17 to 23 has been driven by consistent positive growth in both volume, price, and mix. Diageo's price mix growth, which saw a strong acceleration during the past 2 years, sits in the upper quartile of our CPG peer group. Volume growth, on the other hand, has been steady during this time, with a CAGR in the 2 to 2.5% range during the pre-pandemic years and during the last 4 years. We have invested significantly in technology and analytic tools to support revenue growth management and have built deep data sets, which allow us to get the balance right between price, mix, and volume growth. In addition to growing the top line, we've also expanded operating margin, including over the past 2 years when we faced significant inflation. In fiscal 22 and 23, mid to high single-digit price increases and stepped up productivity savings in fiscal 23 more than offset the absolute cost inflation impact on our gross margin. Volume growth provides us with margin leverage across the portfolio, and improving mix tends to benefit our margin structure. Our culture of everyday efficiency has allowed us to deliver an annual run rate of about $500 million in cost savings each year, dating back to fiscal 17. And we see opportunities to continue to accelerate this productivity. So we have delivered this operating margin expansion while consistently upweighting our A&P investment in brand building to drive long-term sustained growth of our brands. A&P is crucial to strengthening our brand equity and building resilience of our business for the long term. Our sustained and upweighted marketing investment is also a key differentiator of our performance versus our peer group. In fiscal 23, we spent $3.7 billion on marketing, nearly a 60% increase from fiscal 17. Our reinvestment ratio has also increased by nearly 300 basis points over this time period. You can see on this chart that the investment has been in North America and across Europe and APAC. And this targeted A&P investment in our regions is paying off. We have gained considerable market share in all the regions where we have upweighted A&P investment. One key insight that we have is that this A&P investment needs to be sustained over several years on a consistent basis to deliver the right outcomes. We have also spent our A&P more efficiently, growing the impact of our investment by increasing ROI. We've done this through building and utilizing powerful analytical tools and developing our marketing effectiveness capabilities, and by focusing more of our A&P on media. We started to invest in this suite of tools and capabilities back in fiscal 17. These tools have been continuously enhanced, and the number of markets in which they are utilized continues to grow. Catalyst is now in most markets. Demand Radar covers around 90% of both our NSV and A&P investment, and Edge 365 covers around 70% of our NSV. They enable us to use data and technology to ensure that we make the best investment choices at a market and at a brand level. One of our tools is a marketing mix model that analyzes how to optimize our allocation and investment across our portfolio of brands. Another tool, Sensor, helps us to make smart decisions on digital media mix for specific campaigns. These tools and capabilities have enabled us to significantly increase the the ROI of our A&P spend while increasing the reinvestment rate behind our brands. And as I discussed in the previous slide, this is working. The proof is clearly in the sustained gains we have seen in market share over time. Our commitment to overhead efficiency has also supported our strong operating profit delivery. Since fiscal 19, the rate of increase of Diageo's overheads has been the lowest out of our CPG peer group and puts our overall overhead spend as a percentage of sales in the lowest quartile in the group. Over the past 4 years, our staff cost grew at half the rate of organic NSV growth, and our indirect costs held broadly in line with top-line growth. Since fiscal 19, our headcount has only increased by 6%, while our organic net sales are 35% bigger on a constant basis. In these years, we have made investments in critical categories such as tequila, where we have added roughly 1,500 full-time employees, and in key capabilities such as digital and luxury. We have at the same time improved the efficiency and effectiveness of our people, supported by the investments that we have made in data and technology. And as you saw in Deborah's presentation earlier in the day, our people are more engaged than ever before. This has delivered a strong contribution to operating margin over time, and with that supported our ability to invest in the business. Clearly, our profitable growth algorithm underpins our strong past performance, and we believe it will continue to do so in the future. It starts with top-line growth. Going forward, we believe we can deliver organic net sales growth in the range of 5 to 7%. As Deborah discussed earlier, International Spirits has been growing ahead of TBA, recruiting and gaining share from beer and wine occasions. Looking ahead, we expect International Spirits to grow at 5% RSV CAGR, ahead of TBA at 4% per year. And our portfolio is advantaged, and the footprint that we have is placed to allow us to grow faster than that. Our growth algorithm also anticipates that we will continue to invest behind our brands to grow share and grow ahead of the category. I will now discuss the building blocks of volume, price, and mix. Let's first cover volume. As I showed earlier, Diageo has grown volume at a 2% CAGR since fiscal 17, and we expect this to continue. While volume growth may be muted in some parts of the world with more consumers under pressure, with the breadth of our footprint, we have several opportunities to double down. One particular attractive opportunity is India, which in fiscal 23 grew volumes by 5.5%. As I referenced earlier, in the recent 2 years, we have grown price at mid to high single digits as inflation peaked. Going forward, we expect price increases to normalize to 1 to 2 points of growth in line with historic pre-COVID levels. And lastly, premiumization. Deborah showed you how in both developed and emerging markets, the premium plus segment of our business continues to outpace the growth of standard and value tiers. We expect the continued trend of premiumization to drive an additional 2 to 3 percentage points of growth in the medium term. Premiumization comes from consumers drinking better, from category mix and brand mix. Scotch has grown at an 8% CAGR for the past 4 years, and in fiscal 23, Scotch malts grew at 16%, which was double the rate of growth of primary Scotches. Even in the last few months, from the start of this fiscal, in the US, Super Premium Plus is driving all of the category growth, growing at 2.5%, while Premium and Below is declining 2%. In the US, this has been a consistent trend, except during the GFC, when there were 3 quarters without premiumization. Through our strong execution and consistent investment in our brands and core capabilities, we believe we can further outperform the market and grow share, enabling us to deliver our top-line guidance of 5 to 7%. Now, this growth is enabled by reinvesting productivity savings. We see the opportunity to accelerate productivity over the coming 3 years and aim to deliver $2 billion of savings from fiscal 25 to fiscal 27. This is a significant step up in our commitment. Recall that our historic productivity savings run rate has been about $500 million a year. So we intend to deliver this productivity across COGS, marketing spend, and overheads. COGS has historically been the biggest driver of our savings and will be enhanced through our supply agility program, which I will cover a little later. Marketing and overheads efficiencies are expected to continue to fuel our ability to reinvest in the business. I shared earlier how we optimize marketing efficiency through improved ROI. We also go after waste in every aspect of marketing spend, from agency spend to being more choiceful in how we use point of sale material, reusing it, and gaining efficiencies on media. On overheads, we will continue to deliver productivity, including through the investments that we are making in SAP S/4HANA, which is expected to step change our processes and drive efficiency and savings. We're also delivering cost savings from the work that we do on sustainability. For example, when we improve the energy efficiency of our operations, when we reduce the water usage of our operations, when we remove carton boxes from products, we are delivering COGS savings. And with investments like our supply agility program, we're now making a step change to take productivity to an even greater level. Our investment in the supply agility program aims to increase the resilience of our supply operation while reducing our carbon footprint, increasing efficiency, and reducing costs, as well as increasing cash flow. This 5-year program was announced at the end of fiscal 22, and we plan to invest up to $650 million to strengthen our supply chain network and make it fit for the future. Productivity savings from the supply agility program are expected to step up from fiscal 25 and accelerate in the following years. And in line with our growth algorithm, we deploy the additional productivity to drive sustainable long-term growth of the business. Earlier today, you heard Deborah discuss our strategy to raise the bar on execution. And my colleagues have shared with you examples of how we are activating at pace against this. Sally and Claudia shared with you our plans to shape the next chapter of our route to market and operating model in the US. With our distributor partners, we will invest behind this initiative. This is expected to further strengthen the competitive advantage we have in our largest market and provide us with the confidence that we can further accelerate growth. We anticipate upweighting A&P investments in the coming years to drive our business, and we will, as always, take a disciplined and data-based approach to our marketing investment. Our focus on this upweighting will be on brands, categories, and geographies where we expect the best ROI. As you saw through the day today, this will include Guinness, our business in India, our tequila portfolio in North America and around the world, Scotch, of course, North America whiskey, our Western Europe business, Baileys, the non-alc portfolio, and our fantastic innovations. And last night, those who were here in person would have experienced some of the approaches we are taking to drive growth through progressive applications of data and technology. Now on to our long-term investments. We run this company for the long term like true owners. Overall, maturing stock levels have increased close to 50% since fiscal 17. Maturing inventory now stands at over $7 billion and is the liquid gold which provides us our strongest moat. This increased significantly over the past 3 years, driven by the strong growth of whiskey and the explosive growth of tequila. So while the rate of growth in our maturing stocks will moderate in the coming years, we will continue to invest in across aged liquid categories, including Scotch, US whiskey, and Reposado and Añejo tequilas. We will also continue to invest behind capacity increases and our supply agility program. We have previously said that we expect capital expenditure in fiscal 24 to be in the range of $1.3 to $1.5 billion. We expect this level of CapEx spend to continue in the coming years before declining again to historic levels as a percentage of net sales from fiscal 27. And that brings us to our capital allocation strategy, where we use a very consistent and disciplined approach. Our first priority on capital allocation is investing in the organic growth of our business. Second, we invest in acquiring strategic brands that strengthen our exposure to fast-growing categories. More on that in a minute. Third, we have a progressive dividend policy with a dividend cover target of between 1.8 to 2.2 times. Fourth, where we have excess cash, we return it to shareholders. We manage all of this within a target leverage ratio of between 2.5 to 3 times net debt to EBITDA. We ended our last financial year with a leverage ratio of 2.6 times, towards the lower end of our range. Bold and accretive M&A will continue to be an integral part of our capital allocation strategy. As Deborah highlighted this morning, we have actively shaped our portfolio towards more premium brands in faster-growing categories over recent years. Importantly, we have also disposed of $1.6 billion worth of brands that did not fit within our portfolio and mostly played in slow-growing segments. The net impact has materially contributed to the shift of our portfolio towards premium plus price tiers. Coming full circle, our long-term growth algorithm and disciplined approach to capital allocation allows us to create value for you, our shareholders. Aside from fiscal 20 and 21, when the business was impacted by the once-in-a-generation pandemic, our ROIC has increased by 250 basis points since fiscal 17. We make capital allocation decisions for the long term. Increased investment in maturing stock, CapEx, and acquisitions in fiscal 23 reduced our ROIC in the year. However, we believe that this will contribute to increasing ROIC over the long term. Now on to dividends and share buybacks. The progressive dividend policy I previously mentioned has delivered consistent year-on-year dividend growth for over 20 years, including in fiscal 20 when COVID significantly impacted the business. We expect to remain progressive dividend payers in the medium term. And we have returned £9.3 billion of capital back to shareholders since fiscal 18 and continue to add to this with the current program to return up to $1 billion further to shareholders by the end of fiscal 24. $1 billion further by the end of fiscal 24. Our approach on buybacks will be determined annually in line with our capital allocation strategy while remaining broadly within our leverage ratio. Our disciplined approach to capital allocation will remain unchanged. Just waiting for the part. Before I summarize our medium-term guidance, let me start with our fiscal 24 outlook, which we put out last Friday. I am disappointed that we are no longer expecting organic net sales in half one fiscal 24 to grow faster than half two fiscal 23. And we are now expecting operating margin to decline versus the previous year. I think I need to read because this thing is not working. Can you say that to me? Yeah. Thank you very much. Technology troubles. Get back to paper. Okay. Let me start again with this chart. Okay. I am disappointed that we are no longer expecting organic net sales in half one fiscal 24 to grow faster than half two fiscal 23, and we are now expecting organic operating profits to decline for the half. In half two fiscal 24, we expect to see gradual improvement in NSV and operating profit growth compared to half one fiscal 24. But this does not detract from the confidence we have in our long-term growth algorithm. In the medium term, we expect organic net sales to grow within a range of 5 to 7%. As we have mentioned before, our confidence in this guidance is underpinned by our participation in the attractive segment of international spirits, our advantage portfolio and footprint, which enables us to grow ahead of spirits, and the investments we will continue to make to grow share. With only a 4.7% value share of global TBA, we have significant headroom for continued growth. On to operating profit growth. In the near term, while inflation has moderated, it is persistent. And as I mentioned previously, price contribution to the top line is expected to moderate faster than inflation, back to 1 to 2 percentage points. We expect this to be different from the past 2 years, where we have covered the absolute impact of inflation with pricing. In this environment, we will continue to accelerate productivity savings and benefit from operating leverage, premiumization, and revenue growth management. We expect organic operating profit to grow broadly in line with the top line as we choose to continue to step up A&P investments to support our brands. As I covered earlier, we generate strong returns on these investments. We have the tools and the capabilities to continue to invest with confidence, and as we have demonstrated in the last 3 years, our investments are translating to share growth. Over time, we expect operating margin growth to increase as inflation abates and the benefits of the Supply Agility Program flow through. So in closing, here are the key takeaways. We have delivered consistent, high-quality, strong performance. We are committed to doing business the right way. I'm really excited about Diageo's future because TBA is an attractive industry, and within that, spirits are an even more attractive segment. We have an advantage portfolio of fantastic brands. We have an unrivaled geographic footprint. With only a 4.7 share of TBA, we have a long runway for growth. And finally, with our growth algorithm and our capital allocation strategy, we are confident in our ability to deliver long-term, sustainable shareholder value. So thank you very much. And now let's open the floor to Q&A. Deborah? Thank you.
Very good. You got within the last 2 slides.
I know.
Okay.
Great, thank you very much. And these have been terrific presentations. Just want to kind of circle back to some of the discussion we had in the beginning and tie it together here a little bit. And that is, and we've been getting a lot of questions from investors on this, is, you know, given the fact that cost of capital is elevated everywhere in the world pretty much, the macro issues are pressing and increasing, you know, globally, and it's kind of hard. I mean, we don't know your distributor or route to market in every single country in the world, obviously, but it's kind of hard to believe, or put it the other way, we would like to have, how do we have confidence that you don't have, you know, significant inventory in the supply chain hidden out of view in, you know, other important markets around the world?
Yeah, I can take that.
I was going to say, and then look, I mean, if it's helpful at all, maybe we just circle around to the president so that they can talk a little bit about this. That might be.
Actually, that may be the best way to do it. I mean, look, I'll just kick off with like North America. I mean, it's a 3-tier structure. We have full visibility to what we sell to our distributors. We have full visibility to the depletions that they have, the big distributors, the depletions by account. And we have this on a monthly basis in terms of the depletion data, real-time data on distributor inventory levels. And we have been very explicit in sharing that with you all as well. So it's a fundamentally different market structure in North America.
Yeah.
And then in Europe.
I was going to say, and I would also add it in North America, of course, tools like Edge and some of this. Remember, this covers 300,000 outlets. We've got a dedicated division within the distributor that are out there in outlets as well. So hard to hide inventory in North America. Even below the distributor level. And then I don't know, John, do you just want to talk a little bit about APAC?
Sure, is my mic? Yeah. So if you just break down APAC, let's take the mature markets: Australia, Korea, Japan. They're all got very established retailers. So we got very good EPOS data, point of sale data. So feeling very good about that. If you go into my biggest market, Greater China, Baizhu business, we work with exclusive distributors. So they only carry our stocks. We've got excellent visibility on that. And by the way, you don't grow 21% in the last quarter unless you're in a good stock position. And then you move into Southeast Asia, which does have some similarities to Latin America. But I'm very comfortable in how we finish the fiscal. And we've got good visibility, which we also check through third party as well, through those markets. And then in India, just very briefly, 50% of our distribution is with the government-owned distributors. Again, excellent visibility. So on balance, I mean, it varies by region, but feeling that we've got, I'm feeling good about where we are right now.
And India is fundamentally different for this business than any other CPG business. The total number of outlets in India is less than the total number of outlets in Greater London. Okay, so the visibility is fundamentally different.
Dalen, you want to go do Africa maybe?
Yeah, so if I look at the African business, 65% of our portfolio is beer. And if you think about the beer businesses, average 30-day shelf life. So the beer business has a low shelf life. But also majority of the portfolio is in what we call RGB, so it's returnable glass bottles. So you got to ship out, you got to wait until it's consumed, bottles come back, then you reproduce and ship out again. So that part of the portfolio is very, very well managed. So you know exactly where the stock is. Our biggest spirit market is South Africa. And if you look at the South African business, it is a big formalized trade channel where you got big retailers. And it's day one, day three shipping. So we know exactly what stock is in the trade. So from an Africa perspective, I feel comfortable. We know exactly, and we've got our hands around the inventory.
And maybe I'll finish with Europe.
Yeah.
Yeah. So again, majority of the Europe business is big modern retailers, the Tesco, Carrefours kind of thing. We do have some wholesalers in Europe, and actually we look at their orders on an everyday basis. And that's been the practice in Europe for a very, very long time. So it is a very well-controlled channel. So I think we've pretty much gone around the world.
Very good.
Lawrence?
Hi, Lawrence of Barclays. You talked about taking brands global, particularly tequila, but I guess Guinness is one of the brands that actually has a relatively few countries that it's sold in. UK, Ireland, Africa, I mean, is in other places as well. But obviously beer has massive markets elsewhere. You've got Brazil, Mexico, much of Southeast Asia, where some of your competitors have big positions. Is there potential to take Guinness to more places?
Yeah, I mean, so actually Guinness is actually sold, I want to say 130 countries that Guinness is available. I'm looking at John and the beer board.
Yeah.
The deal is, though, we actually operate in a lot of countries through other parties. So we are not holding. It's actually one of the beautiful pieces of our Guinness business is the fact we really run it in a very asset light and efficient model. We're not having to. We've got quite a different model than sort of the beer companies, of which you're building big breweries and you're having to invest in a lot of big infrastructure to make that work. So, and in fact, you would have just seen some divestitures of assets that we did in Africa as an example. So we take a look at these to say if there's somebody else who can do it better than us, we've got models for that. So actually, we do have Guinness out there. I will say we are seeing opportunities, though, yet for Guinness. John, you've got one in APAC that you're looking at. So we are looking at Guinness as well. And I think the exciting thing, as I am looking at like 0.0, I think we're only in maybe, is it 5 countries right now? I think so. and quite honestly, that just so delivers versus kind of core Guinness. So we're looking at that, but we do actually operate in many more countries than what it would at first appear. But it's just going through, in many cases, some of our beer competitors, actually.
Could I ask another one about guidance? Is that okay?
Yes.
Yeah. So in terms of you've got this sort of medium-term guidance with limited margin expansion over the medium term. Going into next year, we're sort of assuming that some of the issues you've had in LAC, you're going to start to lap, and so potentially some of the operational leverage that you'll lose, you should get back next year. And some of your competitors in tequila have talked about the benefits of the agave price. Presumably, you would be getting some of those as well. Some of your competitors have quantified that as well as all of the COGS deflation that's coming into the market right now, and again, well documented by some of your peers. With that sort of environment, it seems like a huge amount of A&P to put back into the business to be able to get a flat margin. Why are you just not being very conservative here?
I mean, look, I think it's a mixed bag. There is definitely, we do recognize that we do expect that agave prices will continue to come down over time. Having said that, look, we have more of our portfolio is in aged liquid, so it's just going to take us a little longer for that to show up in the P&L, right? In terms of inflation, just a couple of things that I do want to call out. Look, the world's a complex place. We're definitely seeing some moderation in inflation, but then there are some key commodities which are more relevant for us than they perhaps are for others, where we are continuing to see inflation persist. And so, I mean, I kind of look at like UK gas, and we have this is publicly available data, right? Looking at forwards, data for 25, 24, and 25. 25 is like £1.32 per term versus today's price of 1.15. So the forwards still indicate, continued inflation. Aluminium is another place. Today aluminium's at around about 2,500 or so per ton. Next year forecast to go to 2,650. This is where the forwards are. U.S. gas again continues to be inflationary. $3.23 per MBTU, now going up to 3.7 next year. U.S. resins is the other place where we are continuing to see inflation. So there are definitely pockets where we are continuing to see inflation persist. It's coming down in some places, but continuing to persist in other places. So I just take a more balanced view of, what's happening to inflation in total here across the next, at least as far as we can see, right, the next 2 years of forwards. It is going to be still, inflationary in quite a few pockets.
I do think, though, that's, if I could just reiterate again, it's not a change in ambition. We want to grow, and we also want to expand margins. So clearly, if inflation is better than what we're predicting, that's what we're looking to do. So it's not a change of, we're going to spend this and not
no matter what.
No matter what.
Yeah.
And it is certainly not that. And we're also, we aren't going to take some kind of big holiday from it either. That's not what we're saying. So. That's why I think the intent is important here, but it really is, as we're looking at it, we do want to make sure that what we're doing is protecting the long-term growth and not making short-term decisions to make cuts as this, inflation volatility flows through, because when you think about how we've gotten there through these, high single-digit pricing actions, this is not the environment you're going to be able to get that through. In the short run. So hopefully that helps clarify.
Thank you very much.
Simon. Thank you, Lawrence.
Hi, it's Simon Hales from Citi again. Can I just come back to the capital allocation policy? Lavanya, you talked about sticking with the 2.5 to 3 times, sort of leverage range. I think, after last Friday's sort of warning, I think we're probably looking to finish the year probably at the upper end of that range with the $1 billion buyback, sort of continuing to be executed. I mean, how comfortable are you to be at that upper end of that range going forward? How do we think about future sort of buybacks into 2025 and beyond? Are you happy to stay up there? Would you prefer to see the ratio head back towards the lower end of that guidance range before you think about further cash returns?
We have a very strong balance sheet, and we have excellent credit rating. We're able to access debt at very reasonable rates compared to the market environment that we're in. Our intent is to stay within the range. We ended last year at the lower end of the range, right? And a lot of this also depends on, what are the opportunities. Our capital allocation is actually incredibly clear, right? We invest in the business. We've given pretty good guidance of what we intend to invest in the business on both CapEx and maturing stock. On M&A, that's the place where it really differs year to year. If there is a great opportunity available, as I said in my presentation, we will be bold about making these M&A decisions. Equally, to a question that came up earlier, we're active portfolio managers, and we will look at disposals as well. And there's a continuous list of those that we're also always looking at. We will pay dividends, and we've been a progressive dividend payer, and we intend to continue there. And then share buybacks, I think we'll make that decision each year based on what's happening with the rest of the capital allocation, choices, requirements that we have.
Fintan?
Thank you. Fintan Ryan here from Goodbody. Maybe just to follow on from Lawrence's question earlier, given that you're saying that you're still seeing aggregate inflation into next year, we've seen significant pricing being taken by yourselves in the overall TBA industry over the last 2 to 3 years, but you're saying pricing midterm is going to just be 1 to 2%. If the inflation is still running ahead of that, why are you, let's say, pricing below the inflationary basket? And if anything, could this mean that your guidance is conservative? Should the overall inflationary backdrop stay quite persistent?
So I think, there's a number of things that we have to help us offset that type of inflation. So remember also the productivity agenda as well, which absolutely helps us, and particularly on a marginal basis, absolutely helps us. And so the goal absolutely is still to be on an absolute basis to be able to offset that inflation. It's just a matter of offsetting that inflation and doing the reinvestments that we need to make. So that's where it sort of comes in, is it's to think that you're going to be able to price above that inflation to be able to drive additional. And we have some great productivity programs coming through, but some of these bigger programs take time to get the full benefits of those. So, but there's a number of pieces in there, but absolutely we would still look to, through pricing, productivity. We also get leverage on volume growth and that type of thing to make sure that we can do that.
Cedric Lecable, Stifel. I have follow-ups on the midterm, what's midterm and what's long-term. And actually, you gave some sense of where CapEx would go. You gave some sense of productivity programs kicking in and accelerating. So you have a view that maybe 2-3 years from now, you'll have some positives coming in and helping profitability. So my first question is on A&P. You raised A&P everywhere over the last years, but the A&P investments in relation to sales is quite different from a region to another. So how should we think about that? How should we model it? Do you think North America is a benchmark for the other regions in 5-10 years? Or do you think there are some specific reasons to believe that one region deserves less A&P than North America? And the second question, sorry for this long intro, is about the kind of midterm guidance. Should we understand that there's a 25, 27, and that long term comes in 27, 28 because of all you explained before? Thank you.
Yeah, so I think we've said before, I'll take the A&P and then you can take kind of a medium-term, long-term question. So, on A&P, we don't target a specific rate. And in some cases, if you think about sort of alcohol around the world, like we do have certain markets that are dark markets, as an example, where you can't do as much. So it's not necessarily like for like. This is what I tell the region. All the region presidents are looking now to see, is she gonna give me money? But in all seriousness, there is real differences, and we do take a very rigorous approach on looking at the return for that. So, I wouldn't say from a model standpoint, taking a 20% and sort of straight lining it, may not sort of be the right way to look at it. Trying to think what I would suggest for you on a model. I don't know. We'd have to follow up. Somebody has to follow up with you on that, I think, on what we would suggest you model in. But
look, I mean, and it's also not at a regional level. I mean, it is market by market, right? Because the opportunities with the consumer is definitely market by market. And a lot of it is going to depend on where the consumer is at in different markets at different points in time. I mean, during COVID, I mean, there were certain markets where the consumer wasn't going out. There was just no interest from the consumer. And so we pulled back A&P investment in those places. And then where the consumer was, much more active, we invested more in those places. So some of this is also going to depend on where the consumer sentiment is in different markets at different points.
I think you did call out. I think we did call out a couple places that we were clearly going to invest in Lavenia's piece on Western Europe. So that was actually a region that we did call out.
So
trying to be helpful from a script standpoint.
Medium-term guidance and the timing within that. I mean, look, it's in some ways it's hard to put a date around it, and I do mean to be helpful, right? I'm not trying to be unhelpful here, but as Deborah said, if inflation comes down faster, we'll get to the long term sooner here, right? Because the part that's within our control and which was in my presentation is when do we expect the savings from a supply agility program to come through? And on that, we know that we're going to start seeing more of it from fiscal 25, and it really accelerates from fiscal 27 onwards because that's within our control. We're executing this. We know we will get this done. But on the macro perspective, from an inflation perspective, I think that's a bit of the unknown. And so, I just don't think it makes sense for me to be committing to a date when that will happen.
Sarah?
Sarah Simon from Morgan Stanley. Can we just stay on the medium term? You obviously reiterated your guidance for 5 to 7% top line and margin improvement at the full year, and then kind of implicitly at the AGM trading statement. So I'm just wondering what's changed in the meantime. Is it that you think that to achieve the 5 to 7, you have to spend more on marketing? Or is it that the supply chain agility program is yielding savings which are more back-end weighted? Because obviously we get the short-term stuff, but the mid-term, I don't think I really understand why you're more cautious about the ability to drive margin. Because inflation has been an issue for ages. It was there at the full year and it was there at the AGM. So that it seems to me it can't be that. Thanks.
Yeah, so I think, look, and unfortunately, the thing in Latin America sort of has muddled our message here. So I do get the issue. So clearly in the near term, and the change and the Friday announcement was around sort of what is happening in Latin America. And so that is a very distinct issue sort of in and of itself. So how we're thinking about and what's hurting our margins in this sort of near run is really about that and not about sort of how we're thinking about medium term. So hopefully that clarifies some of this. Look, I think the medium term guidance that we, reiterated, as I said, there is not a change in sort of ambition of wanting to get there. I think as we have really started to look in detail at what we needed to do to get to the 5 to 7, and really, I mean, the goal is to get to the top end of that. As you get to the top end of 5 to 7, the margin flows through. So, as we started to look at what that spending was going to be and the consistency of the spend, that was very important in order to really look at 5 to 7. And so then you start to take a look at the macro and some of the pieces on inflation, of which that has persisted, and there's been things, as example, I mean, the energy example is probably the best one. October 7th changed things in Europe from some of the energy things that we were reading to, so there's just a lot of volatility out there on sort of some of the things that we're reading through. So I would say we now have much more foresight into where we want to spend to be able to drive the 5 to 7. And then you've got the macro uncertainty. As Lavanya said, we know what we can do on productivity. And so this is just where the timing and phasing and lining that up really made us go back to reassess sort of that operating profit commitment and to make this determination of kind of the medium term to long term. I don't know if I explained that well or whether you want to. Okay.
John?
Very good.
Thanks. You mentioned in the growth formula, the 1% to 2% price is kind of back to what the business used to do. Curious what's happened to the elasticity. I mean, in some consumer-oriented industries, people have a really good beat on the elasticity and how it's changed. And you just went through a period where you were pricing at a very different level. And I wonder, given what we're saying about inflation, how much is the elasticity kind of informing the fact that we want to get the price increases back down, maybe even below inflation?
Well, I think, look, one thing to remember during sort of the COVID super cycle and sort of all of that, it really, the volumes have remained really steady, really from from TBA standpoint to the industry. And then when you get to our volumes, it's been pretty steady. It really has been in this price mix as people really are mixing up. But when consumers are under pressure, this is really when it's not just our industry, but the basket that matters. And so what we see are sort of people making kind of smart shopping choices. And this is where to think you're going to be able to push through high single digit pricing is just really not realistic. So, that's kind of the pricing environment. Of course, we're always looking at our big brands and where we have leadership and where we have, really precious liquid. We are always doing some bit of looking at pricing. We're not just pricing to cover inflation. Like, we think about pricing more strategically on where we want brands on the price ladder and as such. So it really is a consumer back look. And so that's what informs sort of this thinking of we're going to go back more to this is part of the normalizing of, I would say, the industry. And that 1% to 2% is a pretty good assumption.
I mean, we have excellent data. That's the one thing that we have built over the last, several years, going back to like 2017 when we started to invest in revenue growth management tools and capabilities. And so I talked a little bit about these data sets that we have. And the thing about this is that the more data you collect, the better the whole data set gets, because you're able to make better, you get to better insights through that. So that's one thing I'd say. The second thing I'd say is that in this business, especially on the aged liquids part of the business, it's critically important for us to get the mix between volume, price, and mix right, okay? Because we're disgorging barrels to fill them in, right? And so if you go through a period of no volume growth, you just, the model just doesn't work, right? And so we take special care on this business to make sure that we have the right balance between volume growth, between, price and mix. And it all needs to come together because, again, somebody has put in liquid for us to take out 12, 15 years ago. And they didn't know about the pandemic, they didn't know about the super cycle, and they don't know if a recession will be on the cards here either. And so we have to manage this in a very different way than just, categories that do not have this aged, phenomena.
One last question, maybe Celine? No, excuse me. Oh, that's fine.
Yeah, Céline Pannuti from JP Morgan. Yeah, in fact, it was a follow-up on that equation. So you said that 2 to 3% is your mix. And I think if the math probably was that, if I look at the last 7 years, was as probably around 2 to 3%. Now, you presented that, I presume a lot of that mixed benefit came from North America, where we've seen how premium and super premium did develop quite well for you in the portfolio over the past years. So I just want to understand why there would be as much mixed benefit if I think it comes from emerging market. That could be a bit of a headwind. Or you were mentioning down trading in Asia, in Latin America. So just trying to understand the visibility that you have on that mix driver.
Actually, mix has been a contribution across all regions. And North America has not actually been the highest driver of mix benefit for us. There has been a mixed benefit that we've gotten in North America with primarily the shift, the category shift. So the shift into tequila has given us a mixed benefit in North America. But equally, I mean, like if I look at Europe last year, price mix in Europe was 11 points, and again, a lot of this was coming from premiumization and consumers trading up within Europe.
Yeah,
of course.
Remember in Europe, actually, our business is actually quite standard. So it's not, if you think about Europe looking like the US, it actually doesn't. It's quite a standard priced portfolio. So that actually Europe's had quite a bit of a mix up. But it's at sort of a different place than even sort of where the US is.
And APAC has had significant mix benefit as well. India has had huge mix benefit. Hina talked about it in her section. I mean, with Scotch has been growing at like 30+% versus the lower segments, which are declining 2%. So we've actually seen that premiumization is a global phenomena. Dayalen talked about it a little while ago about how people are trading up from mainstream beer to mainstream spirits to premium spirits. We're seeing this across the board.
Thank you.
Thank you.
I think I have one more. Okay, so this ends the webcast. Thank you for joining us.